In this week's video, from a probabilistic perspective, we'll try to answer the question, can central banks push markets above what could be potentially strong sources of resistance? We'll look at numerous risk-on, risk-off charts. There are still similarities to bullish periods. However, we also have resistance on these charts that is similar to topping periods. So we've got somewhat of a battle taking place here, which means we have to remain extremely flexible. We'll finish up with silver, gold, and commodities. Their recent moves tend to side with bullish and reflationary outcomes induced by central bank intervention. You can't invest today without following central banks. Here are some key dates coming up. We've got a Jackson Hole speech this week from Ben Bernanke. European Central Bank has their statement on September 6th. We wouldn't anticipate that we'd get anything too formal here from the ECB. They don't want to upstage the German court. The German court is issuing a ruling on the European Stability Mechanism, or the bailout fund. That ruling is expected to come on September 12th. It is also widely expected that the German court will uphold and approve the bailout mechanism, clearing the way for the ECB then to announce formal plans for intervention in the Italian and Spanish bond markets. Finally, we've got a September 13th Fed meeting and statement, and we need signals from a bullish perspective hinting at or announcing QE3. If you'd like to watch this video in full screen mode, you can click in the lower right-hand corner of your video player. This is a weekly risk-on, risk-off chart that we've examined in the past. We're looking at the ratio of the S&P 500 index to IEF, which is the intermediate term treasury bond ETF. When the ratio here is rising, risk is on, stocks are in favor relative to bonds. When the ratio is falling, bonds are in favor and stocks tend to do poorly. This is the weekly S&P 500 here for a reference point. A ratio, or a relative chart, also succumbs to support and resistance. This line here can act as potential resistance for the ratio. This is support. Why is this chart potentially important, and why will we focus quite a bit of time in today's video on this chart? You can see here, when we're near the resistance line, if we come down on the ratio, that is a point where the S&P 500 peaked and for the most part did poorly following this point here. In a similar vein, when the ratio hit resistance here on a weekly chart, the S&P 500 did poorly following this point here. Our concern today is we are once again running into resistance. There's no question that this line has acted as resistance. We've bounced off it in a bearish manner. Here, this point here looks similar to this point here and here, when stocks for the most part did poorly in the weeks following and the months following. Come down here, support, stocks did well after. The ratio comes down and finds support roughly near the line, stocks did well after. The ratio comes down to the blue line here and finds support, stocks did well after this point here. So whether or not we break out in a bullish manner, that's option one. Option two is that we continue down here and bounce up. Option three is we continue down and have a bearish break of this lower support band. To improve the clarity of the charts and the resolution on your screen, use this button in the lower right-hand corner of your video player. We believe it's fairly easy, looking at the exact same ratio here, to make an argument that this pattern is a symmetrical triangle. So here's your triangle in this area here. So what we're trying to determine is, are the odds that we're going to break higher, move lower, or even have a bearish break? According to StockCharts.com, a study by Edwards and McGee suggests that roughly 75% of symmetrical triangles are continuation patterns, and only 25% mark reversals. So a continuation pattern would tell us that the trend that was in force prior to the formation of the triangle should remain in force roughly 75% of the time. Now let's look at the current trend of this ratio. If 75% of the time a symmetrical triangle is a continuation pattern, our purpose here is to demonstrate that the current trend is up, and if it's a continuation of that trend, it would continue up. This is the same ratio, SPX, S&P 500 divided by IEF, the 7 to 10 year Treasury. Here we've got a downward sloping trend line, a break of it here. That's step 1 for a bullish trend change. Step 2 occurred here when the ratio made a higher low relative to this low, upward sloping trend line. Step 3 is that you make a higher high. So here's a trend change from bearish to bullish, or from risk off to risk on. Again, recently we had the same thing. Still looking at the same ratio of risk on to risk off on a weekly chart. Our belief is that maximum fear for Europe occurred here. And you can see the ratio was making a lower low in a bearish manner after making a lower high here. So we're in a downtrend here, and this is where we begin to reverse to an uptrend. Now we've got a series of higher lows shown by the green line here and a series of higher highs. This high is higher than this high, and this high is higher than this high here. We have an established uptrend. Our analysis in recent weeks has helped us maintain a bullish bias. However, at this point, with this line acting as resistance, it's extremely important that we remain open-minded and flexible. We're at this point now, similar to this point here, followed by weakness, similar to this point here, followed by weakness. We believe the weight of the evidence supports a bullish break here, whether that occurs now or in several weeks, but it doesn't mean we have to get a bullish break. We could follow this path here or this path here in the weeks ahead. In terms of a bigger picture or longer term / more sustainable shift from risk off to risk on, we're about 2/3 of the way home. Here we've got a downward sloping trend line on our ratio, step 1. This is a bullish break of that trend line. Step 2 is we made a higher low here relative to this low and this low. The other thing that came from this was this breakout, bullish breakout, is quote-unquote confirmed. What once acted as resistance in these areas here now acted as support. So this was somewhat of your early buy signal. We did begin buying in early June. This was a good sign that the ratio bounced off of here to complete the trend change off of this downward sloping trend line, which is important from an intermediate term perspective. We still need to complete step 3, which would be for the ratio to make a higher high above this line here. In the next portion of this video, we'll look at several indicators on this weekly ratio here that we've been examining. The purpose would be we're trying to see if the indicators are telling us that the odds favor a bullish break to the upside or a reversal and potentially even a bearish break of this lower trend line here in the symmetrical triangle. We're still looking at the same ratio here. Here's the ratio risk on, risk off, S&P 500 here. Now we're adding indicators to the bottom. This is the weekly Copic curve. This is the present day here. We've seen recently the curve has turned up from below the center line, from below zero, and is now moving up in a positive manner. This point A is near the present day where we are now. The last 2 times that happened here, you're getting a turn up from below zero or below the center line. This is the stock market here, weekly S&P 500. After this turn here, stocks did well. Here, in October of 2011, point A2 is similar to A here in 2012. From this point, gains followed in the stock market. We also, in the present day, near point B here, have this curve. The curve is crossing the center line. That's similar to this point here in 2010, B1. Here's your centerline cross. Stocks did well following that. Again here, 2011, this point here, similar to this point here. The S&P 500 did well after this point. Before we show what appears to be bullish signals on the weekly full stochastic indicator, we do want to point out one concern that we have. If you go back and look at our videos over the last few weeks, we have lines here that say stocks did well after this point. Stocks did well after this point. And what you'll notice is the duration of this move here is much shorter than the duration of this move here. If that trend were to continue, you could make an argument that a reversal at this potential form of resistance here would fit that pattern in that long move, shorter move reversal. So it again tells us to be extremely open-minded. Now what appears to be bullish here is in the present day, full stochastic on the ratio that we've been examining moved here from below 20 to back above 80. The last two times that happened were here. We're moving from below 20 to above 80 here. Gains in the stock market followed. Here, below 20, similar to this point here, we're moving to above 80, similar to this point here. Gains followed. Now just examining the ratio itself, this is the S&P 500 weekly here. Here's a peak in 2011 in stocks. You'll notice the ratio had already made a lower high here, giving you a bearish divergence, telling you to be careful in this area here. In a similar manner, when we got this false fake rally here in the summer of 2011, the ratio of risk on to risk off continued to show a bearish divergence. Here, we had something similar happen on this reversal in 2012, earlier in the year. You can see a noticeable lower high in the ratio here, telling you that this move here may not last. In the present day, we don't have anything like that yet. We've recently made a higher high. If we were to see something similar to this or this, then we would become more open to a rollover and bearish outcomes in stocks, commodities, and risk assets in general. This is MACD on our same chart. What is MACD telling us? If you know anything about technical analysis, you know that MACD is widely used and widely used for a good reason. Its signals, especially on weekly and monthly charts, tend to be fairly reliable. What we have in the present day is this black line here in the lower right-hand corner is crossing the center line. And what that tells you is, from a MACD perspective, that this trend here is now up. So the last two times that we had a center line crossover, similar to one that we recently experienced, was back here in 2010. The black line crosses the center line here. This is the S&P 500. Gains followed. Here's a center line cross in early 2012. Gains followed. Conversely here, if we look at what does a top look like, this is a top in stocks. Notice what MACD looks like. The black line is below the red line, showing weakness in this trend here. That's not what we have today. We have the black line above the red line. So this top here really doesn't look anything like the present day. In a similar vein, this top here, where stocks did poorly to the right of this red line here, look where MACD is. MACD's about to make, or already has made, a bearish center line cross. So again, this peak in stocks here, from a MACD perspective, this really doesn't look anything like the present day here. As well here, this is a false rally and a peak. If we come down and look at MACD, it really doesn't look like what we currently have. We already have the black line turning down towards the red line. So as this sits now, it still leans bullish. We could easily see something morph from here to look more like this, and we would become more concerned. In this version of the chart, we're focusing exclusively on the blue MACD histogram. We're trying to see is what does the histogram look like prior to or at a stock market peak. This is the S&P 500 weekly here. This is a stock market peak in the spring of 2010. And you'll notice that the weekly MACD had already shown some weakness here by ticking down. That's not what we have yet. We still have 1, 2, 3, 4 successive ticks higher. So the present day really doesn't look like this yet. Here's another stock market peak in early 2011. I believe it was early February. Notice the MACD histogram had already indicated slowing momentum well before this peak as it came down here. That's still not what we have today yet. This still looks strong. Looks more like this period here than it does this period here where stocks peaked. Here, when we hit an ultimate high in 2011, this is the S&P 500, you'll notice MACD histogram looks nothing like the present day. Momentum had already weakened so much that MACD histogram was below the center line. This period here where we peaked really looks nothing like the present day. Also on this false rally in July of 2011, you'll notice the MACD histogram is below the center line, really doesn't look anything like the present day. If you're a bull, that's all good news. Obviously, if this MACD histogram ticks down next week, then we would be more concerned. But now it still looks more like this period here where stocks went up, or this period here where stocks went up. The reason why we're looking at these indicators on this chart, we've got this downward sloping trend line here. We want to try to determine if the present day here looks like a market peak that we saw here or one that we saw here. Now we're looking at the weekly rate of change. This rate of change is derived off of this ratio here, as are all the indicators that we've been looking at in the bottom portion of these charts. In the present day, two things have happened. The rate of change has turned up from the lower portion here near this green arrow. So this period here looks similar to this period here and this period here. From here, if we move up, it was part of a bottoming process in the S&P 500, and following this green arrow, for the most part, stocks did well and advanced. In a similar vein, present day, turn up here is similar to this period here. If I move up, it was part of a bottoming process and stocks did well. We also have rate of change moving above the center line in the present day, which is similar to this point here. Stocks did well after the blue arrow here. Stocks also did well after the blue arrow here. So all things being equal, this and this tends to lean bullish as long as it remains in force. Like MACD, weekly RSI can be an excellent tool, especially on weekly and monthly charts. Here in the present day, in 2012, we saw weekly RSI move from below the 50 center line here, the blue arrow, back above 50 here. So in the past, we're below 50 here. Weekly RSI moves above and clears the 50 line here. Gains in the stock market followed. Here you get somewhat of a false start. You're below 50 at this blue arrow. You cross momentarily here and get a head fake, and eventually stocks were weaker. However, I'd argue that the ratio itself here already looks weak. The ratio is well below these moving averages that have turned over. That's not the case here where we had bullish outcomes, or here where we had bullish outcomes. The present day here looks more like these green boxes than this blue box where it gave us a bad signal. Here you're below. This blue arrow is similar to this one. This green arrow here is similar to this green arrow in 2012. Here, gains in the stock market followed. I want to emphasize again that we've got gains, a shorter duration of gains, It's possible, if the pattern holds, that this duration would be even shorter. Have to keep an open mind, just see where the market takes us and pay attention to the indicators. This analysis here using the weekly slope is very, very similar to the RSI analysis we just reviewed. Present day, blue arrow shows the center line cross. We've also got the green arrow denoting a turn up from below the center line. The blue and green arrow here are similar to this green arrow and this blue arrow, where gains in the stock market followed. Turn up denoted by the green arrow, blue arrow, center line cross here, gains in the stock market followed. Present day similar to this period here and this period here. Similar analysis using Williams percent R on a weekly chart. In 2012, we've moved from the red box below -80 to the green arrow above -20. The last two times that happened, here, red box to green arrow, gains in the stock market followed. This is the weekly S&P 500. Red box to green arrow back above -20 here. Gains in the stock market followed for several weeks. Same thing here to here and here. This green arrow here is similar to this one here and similar to the present day in 2012. The weekly tricks indicator also seems to be pointing towards bullish outcomes. Present day, blue arrow, we have the black trying to cross above the red. It's not quite there yet. The blue arrow here is similar to this bullish cross here, where gains in the stock market followed, and this bullish cross here, where gains in the stock market followed. Weekly S&P 500 is this line here. We also have a center line cross that is trying to take place, which is similar to this point here. Stocks did well for a few more weeks, and similar to this bullish cross here of the center line, where stocks did well for several months. The recent surge in commodities also seems to support a central bank-induced reflation trend. This is GLD, a chart we've shown before. We showed back here several weeks ago with this green arrow that this break here of RSI was potentially bullish. You can see since then GLD has done quite well. Another point, this is somewhat of a symmetrical triangle. Here GLD was moving in this range here. The fact that this was resolved in a bullish manner bodes well for stocks and commodities and risk assets in general. In last week's video, we showed that the ADX on the daily chart of SLV, or the silver ETF, was sleepy here. We said that this was a potentially bullish setup. Sure enough, the silver ETF took off like a rocket. We now own a SLV and have made 2 purchases of it. It may come back down, may even come back down to test this dotted line here. But there are several bullish signals in place that also seem to support Fed intervention, ECB intervention, and a reflation move in stocks and commodities. Here we also have the downward sloping trend line. We broke above it here in a bullish manner. We've got here a higher low relative to this low. This is a higher low relative to this low. This was your trend change here on this strong breakout on SLV silver. This is the ratio of the CRB index to the S&P 500. We've gone over this chart several times in the past few weeks or months. We own commodities. This was one of the charts that helped us buy commodities weeks ago. Point here is you've got a bullish breakout here. Looks like last week we're trying to move above this consolidation period. This tends to lean bullish for commodities, this candlestick here, and bullish for risk assets in general. You can see the weekly MACD histogram on this ratio ticked up. That's a good sign. We're holding this bullish RSI breakout here on the ratio, and as we mentioned weeks ago, this is what we really want to see. We want to see RSI on this chart break and hold 50. Hopefully we'll see that, and we'll also see a higher high on the ratio here, which would be step 3 on this trend change and a good sign for risk assets in general. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.